Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome. We have a huge episode today. My name is Bryce, and today we are looking at Kiss selling their music rights. We have Pimp My Portfolio and not financial advice from some of the, shall we say, best TikTok investors. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. A lot to cover, none more so than the TikTok investors.
I know, a bit nervous about that one.
No, it'll be good.
Yes,
It'll be good.
well, let's get stuck in. A couple of follow-ups from some conversation that we had last episode. We were chatting about the granolas, or Europe's answer to the Magnificent Seven.
Yes, the Magnificent 11.
The Magnificent 11, yes. 11 stocks that had been piled together. And we realized that the Aussie market doesn't have the acronym equivalent.
Yes, yeah.
So we put out the call to the community and went away with some homework to see if we could come up with some acronyms ourselves. And our longtime friend of the show, Charlie Viola, sent us a message a couple of days later. He's come up with an acronym for Australia's version of the Magnificent Seven.
Okay, what's he got?
He's got banker.
Well, I mean, without even knowing the spelling, that seems fitting, given we're a country of bank and miners.
Exactly. I think top 7 stocks is 4 banks and 3 miners.
Top 7 stocks.
In the ASX 200,
Yeah.
So he's coming with...
Sorry, no. They're just 7 of the biggest stocks. CSL Plays Golf does it.
What do you mean?
Nah, don't worry.
I think they're the... Oh, yeah, I see what you're saying. 7 of the top 10 or whatever it is.
Yeah. You've never heard that saying before?
No.
It's big in like footy content when it's like, here are the top 5 players from this week, and like a standout player doesn't get in. It's like, oh, what, Isaac Heaney plays golf, does he?
Gotcha.
Anyway, Bryce, not up with pop culture.
I don't think... But is CSL bigger than those 7?
Yes, bro.
Okay, nice.
See, the biggest 3, it's BHP, CBA, and CSL.
Okay, nice.
Jeez, do you host an investing podcast?
All right. Well, anyway, Charlie has come in with banker, and so he said BANCCR.
Okay, so what? Just give us the companies as you
obviously
spell it
playing
out.
On the banker. So B for BHP, A for ANZ, N for NAB, C for CBA, C for CSL, and R for Rio.
Okay, so he hasn't just done banks and miners.
Yeah. He also wanted to try and fit T for, I think it was Telstra. And then Fortescue in there as well.
I mean, the thing that my biggest takeaway from this is Australia doesn't have enough big companies that start with vowels to make this work. Over in the States, there's a lot of A's. You've got like your Alphabets and your Amazons, whereas we really have ANZ. Yeah. And then you've got a lot of consonants, hard consonants as well.
Yeah.
You've got like R's and C's, B, T for Telstra, F for Fortescue.
Canberra, yeah. Anyway, thanks, Charlie. Let's keep the conversation going.
Well done, Charlie. Appreciate it.
Yeah, very much appreciate it. And keep the conversation going in the Equity Mates discussion group on Facebook. We'd love to hear from you. Another follow-up, we were speaking about the investment in Fairlight last week, the small cap manager. They say on their website that they invest in market cap range between 500 million and 30 billion. However, when we were looking at their top 5 holdings, Constellation Software was part of that, which has a 50 odd or
thereabouts. It's
like
75 billion Canadian dollar market cap, which is like 55 billion US.
And so we had the question, is this just because they're now letting their runners run, which we hoped was the answer. Luckily, the guys at Fairlight, Will and Nick, were listening to the show and came calling and, yes, confirmed that they do let their runners win. So their winners run.
Yes.
They do still buy within that 500 million to 30 billion market cap range. And they also confirmed that the fund can be hooked up to share sites. So few little things to close out there, Ren.
Great. All right. So you mentioned at the top of the show, we wanted to speak about Kiss, the band, because they made headlines last week. They sold their music back catalogue for $300 million. Now, this is part of a much longer trend that has really been playing out, I'd say, since like 2018, 2019.
Yeah.
A lot of major artists have sold their back catalogs for serious money. Bob Dylan, an estimated 300 to 400 mil. Stevie Nicks, 100 million. Imagine Dragons, 100 million. David Bowie, 250 million. Bruce Springsteen, I think he's the biggest so far, an estimated $500 million. And there's an investing story here, and there's an investing story that we can participate in. So we wanted to talk about it, given that KISS had brought this right into the forefront again. So I think let's start with the investing logic behind buying music back catalogs for massive 9-figure sums. The reason is that with the rise of music streaming, Spotify and Apple Music, music back catalogs have become quite reliable annuity-like streams of income. And what do we mean by that? Pretty consistently every month they will get X million streams, and those streams then translate to payouts from Spotify and Apple Music. I think we did the maths on Justin Timberlake's back catalog. I think he sold for 100 mil. Yeah. Don't quote me on that.
Yeah.
But he does 27 million downloads or streams a month on Spotify.
Yeah.
I think the going rate for a stream these days is about half a cent, so $5 per 1,000 streams. So that works out to be like $135,000 a month,
or 1.4 a year or something like that.
Yeah. So off 100 million initial investment, you're getting like a 1 or 2% yield.
I know.
Not
it's
great.
like, that's what I want. Anyway, we'll get to that. We'll get to that.
And that's the investing logic. Investors were looking for income. This is partially why this became really popular in the low rate environment where bonds and more traditional income paying assets weren't paying a lot of income. Music royalties have really become an asset class in themselves.
Not one that I've ever invested in.
Cool.
Yeah, anyway, we'll get to it. But there are different ways in which you can invest in music royalties. So there's the labels that produce them. You've got the big ones like Warner Music, Sony. I guess there's a bunch of independent labels as well that you could go into. Then there's direct on platforms like Royal.io or Songvest. But then what we want to focus on now is how you can invest in the actual funds that are buying the rights to all of these back catalogs. So the funds that are buying up Bruce Springsteen, funds that are buying up David Bowie, because those are a little bit more attractive.
Yeah. Now, it's a good news, bad news combination. The bad news, like so many things in the investment world these days, the majority of these funds are in private markets and only for the biggest of big investors. So one that you'll see quite often that has bought a lot of music rights is Roundhill Music Trust, which isn't listed, but they get money from big institutions and who want exposure to this asset class. But there is one that is listed. It's listed over in London, and we can buy it through the London Stock Exchange. It's called Hypnosis Songs Fund. Now, they have bought some of the big music catalogs, the Red Hot Chili Peppers, Journey, Chainsmokers, Shakira, and Neil Young. So appealing to a lot of different musical tastes there. Yeah. And they bought a heap more, but those were some of the bigger names. So I had a look at their financials on Ticker because over the past year, it's actually down 20%.
Okay.
Which isn't really surprising because this is an income play and we've seen rapidly rising interest rates, and then you have to revalue all other streams of income relative to the risk-free rate of income, which is, what has rapidly been increasing with rising interest rates. So all interest rate sensitive assets, all income paying assets have been revalued. So the fact that it's fallen isn't surprising. But here's a look at their financials. So 1.9 billion in intangible assets on their balance sheet, and that's where the ownership of music royalties is recorded on their balance sheet.
Yeah.
So 1.9 billion, and last year they did $147 million in revenue. So that's about a 7.5% yield. Pretty good.
Is it?
Yeah, it is.
Okay, nice.
Feel free to fact check me. So that's pretty good. 7.5% yield, more than your savings account is paying. Certainly more risky than your savings account. And I want to get to the risk in a second, but just to close out their financials, despite making $147 million in revenue, they made a loss of $90 million.
Doing what?
Now, this is my question. Where are their operating costs? And it wouldn't be
People.
buying music, because that would be CapEx. So that wouldn't sit on their operating cost line. The depreciation would sit in their operating costs. But
just spending.
Offices, your cost base shouldn't be that high.
People.
Yeah.
Hustling.
Going to concerts.
Yeah, going to concerts. Yeah.
So that's probably my key question is like, this fund is an attractive way to get access to music royalties as a asset class because it's listed and it's liquid and all of that. But you do also have this idiosyncratic company risk, which is they're also a company that's spending $250 million a year in operating costs.
Yeah.
So that's probably the key call out. There are other listed ones. There's a tiny one, Mills Music Trust, which is now just over the counter in America. It's also down 13% over the past 12 months. It's only got a $10 million market cap. But Paul McCartney was, or still is, the major shareholder.
Okay.
But I think it's sort of being whittled down into nothing. And I think that's where this whole music royalty story becomes quite interesting, because they do like music that a lot of these catalogs are seen as like, you know, quite having quite good staying power, you know, that, but even the most popular music will have diminishing streams over time.
This is my biggest, not gripe with it, but where I think about, is this something that I'm interested in investing in? And I'm going to be honest, it's not, because I just think that the economics behind it are just going to continue to deteriorate. You're going to get less and less for every 1,000 streams, I reckon, over, like, you've seen it in many different forms of media. And I also think that there's only a limited pool of really top quality, good, big back catalogs.
Yeah.
And if you've got, like, I understand 7.5% yield, not bad. If you look at ETF, some of the yield maximizer ETFs, they're pumping out almost 10%. So to your point about comparing where you could put your money, but I think the pool is limited with what they can buy. And I feel if you don't, to your point, get the funds that are actually getting the Michael Jackson back catalogs and those music catalogs that are going to be...
No, but you see, even for me, Michael Jackson will have diminishing streams over time, like just as generations pass. The one exception to that rule, Mariah Carey's Christmas song.
True.
That's got staying power.
Like, this is also a business model that's now starting to slowly play out and will obviously gather speed in YouTube.
That would be an interesting one.
A lot of people are buying up YouTube back catalogue.
There was a guy who's got 4.5 million subscribers who posted a video that I watched yesterday saying that he's giving up on YouTube. And I was like, the annuity stream on that revenue.
I think about that as well. Yeah, like our podcast. Like, honestly, podcasting is exactly the same. A little bit different, though, because we still need to turn up every week.
The YouTube algorithm is more powerful than the podcast back catalog.
Definitely. And you can run that without... You could walk away from it for 15... Well,
exactly.
for like a year and still get... If we walked away for a year, our back
the most recent episodes would still get some downloads.
For us.
Yeah.
Yeah, but not to the tune of a 7% yield.
But if any private equity's listening...
Yeah, if you're listening, we'd be happy to talk.
So yeah, for me, it's like if I was interested in a non-bond or dividend stock royalty, income play, so like outside of those two really common income paying assets, I think there are better royalty plays. So this is a royalty play. But there are like, you know, doTERRA Royalties is one that I think about, which is a company listed on the Australian stock market that has a portfolio of mining royalties. Like, for me, that seems more forecastable and more stable than music royalties. I think there are probably more compelling income and royalty plays for mine.
Just on that point, Ren, I'm looking at the BetaShares YMAX fund. So it's an Australian top 20 equity yield maximizer fund, 20 blue chip stocks, not tracking an index, put together to pump out as big a dividend as possible. And the last 12 months, they've been doing 9.12%. So.
Nice. Another income ETF we've spoken about on the show, JP Morgan's Equity Premium Income, JEPI. I just had a look. Their distribution yield, 6.5%. So I think what we can conclude is there are lots of ways to get income in the stock market from lots of different asset classes.
Yeah.
Music isn't that compelling for us, but if you are a musician, the flip side is get that bag.
Get millions of dollars.
I think what we're saying is like the present value of the net present value of your royalty stream is worth less than the upfront money you're being offered now.
Yes.
So get the bag.
Yes.
This is Pimp My Portfolio. Pimp My Portfolio.
We are back with another Pimp My Portfolio, where you get the opportunity to submit your portfolio for our expert to provide some ideas on how it can be improved. As always, we're joined by Luke Laretive from Seneca. How are you?
Bryce, Alec, how are you, boys?
Good. Excited for this one.
Yeah, ripper.
Yes, so we are joined as well by Equity Mate community member Anubav. Anubav, welcome.
Hi, guys.
So Anubav has submitted his portfolio. We're keen to crack in. Before we do, Ren, give us a bit of a high level on the breakdown of Anubav's portfolio.
Yes, so this portfolio is all ETFs, interestingly. It's underpinned by a third of the portfolio is an S&P 500 ETF, and then about 13% of the portfolio is an ASX 200 ETF. So those two ETFs together are a little bit less than half of the overall portfolio. Then we have some thematic ETFs, semiconductors, cybersecurity, Asian technology, hydrogen, battery tech. And then to close it out with about 5% in each of these positions, Bloomberg Commodity ETF and an international small companies quality ETF.
Now, also, I should mention what hasn't made it into this doc is that there are some investments in Raise, Spaceship, and 18% of total portfolio is also in crypto.
Oh boy, that's a new
that's thrown Luke a bit
because I didn't get that.
I know. I'm sorry, not all that info made it through to you, but we like a few surprises here at Equity Mates. So, Anubav, before we get Luke to give his views, how have you thought about constructing? So you've got a bunch of ETFs, some micro investing in crypto. How have you thought about constructing your portfolio to date?
The basic thought was similar, like have a core portfolio and a satellite option. And basically, a core for me would be the S&P 500 and the AXS 200. So I mostly wanted most of my money in that S&P 500 because I'm confident with that market. And then play around with several thematic ETFs. So like I've sold in and out of several other ETFs thematically as well. Like I've sold the gaming ETF, then bought semiconductors. So basically, that's where I chop and change depending, and just have some inflation kind of hedge with BCom, that commodity ETF is a thought, and just have crypto on the side just to get some returns, which has been pretty good as far as now, to be honest. So yeah, basically that was the thought.
Yeah, love it. I'm guessing you're. We'll leave it to Luke. Luke, over to you. What's the name of the portfolio that you've given Anubav?
I've had to quickly rename it.
Okay.
But just quickly, a slight addition to my previous name. It's Satoshi and the ETF Escapade. So it was the ETF Escapade, but I've quickly made a nice little adjustment there on the fly. Okay, so I'm going to go through what I like and then a few thoughts from me on how you can improve. So what I like is I really like your sort of core allocation. thinking about 50% of my money tied up in, S&P, ASX 200. Now, do I think the ASX 200 ETFs, as a general comment, are a good shout? I would say no. The reason why is I think the index doesn't represent the economy. So, those ETFs, index tracking ETFs, the idea is that the stock market's a representation of how the economy works. I think in Australia that's a unique misalignment, for lack of a better word. Now, we can have a conversation about that maybe another day and get into the nitty gritty, but just take my word for it. I really like the allocations to the quality smalls, and I really like the allocations to commodities. I think they're perfectly reasonable. I'd argue for active management, as I always do, but we can... No qualms, shall we say. No qualms on that particular front. I would like to see a little bit less, and listening to you talking now, Anubhav, I would like to see a little bit less sexy story stuff and the sectorial sort of thematic ETFs. A little bit more invested in the foundational stuff, maybe not chasing some of these markets so much. And even if you did want to get into that, have exposure to those things, I would like to see that maybe through like a small cap manager or a small mid cap manager or a active manager who's got a concentrated portfolio and can maybe protect capital a little bit better than just riding the lightning on those sectors longer term. You're trading quite actively by the sounds of it, which is great. I think just don't get caught up in thinking that you can get in and out of this stuff successfully long run. I think it's pretty well proven that sort of timing the market on a macro is really difficult to do sustainably. And perhaps think about, as you do make profits and you do take profits, again, diversifying into some more broad-based things. I think an MSCI All-World ex-Australia type exposure would be probably suitable, as would be some emerging markets exposure, whether that's through an active manager or even just an All-World was going to get you a lot of the way there. So if you got your heart set on buying ETFs, I would though. Finally, my final sort of comment would be, 60 basis points roughly to beta shares for an ETF. You can get an active manager for kind of, 80 or 100, whether that's Fidelity or GQG emerging markets, whether that's, some of the other concentrated global guys that we chat about. There's a lot of good managers out there who've got a sustainable track record for outperforming, who, if you're comfortable paying beta shares 60 odd basis points, I'd be more than comfortable throwing in an extra 20 or 30 and being with an active manager who's actually doing a job for me, rather than just reweighting based on, some esoteric index weights.
What ETF was that in relation to, or was that just
as a general comment around thematics? I think if you're trying to play those thematics, there are great fund managers who do have a lot of potential for outperformance in their markets, who are leveraging some of these themes, but in a more nuanced and kind of preferred way for me.
Anubhav, have you thought about active managers in your portfolio at all?
Not really up to this point, but definitely something I can go and have a look. Like Luke said, like all the thematic ETFs, there, like the management fee is pretty high compared to your like the general S&P tracking index.
Yeah.
So definitely I can put a thought to active managers manage ETF to something that I don't have an exposure to. That was my another question. Like, how many ETF is too many ETFs? Since I'm not going the single stock way, is it like too much diversifying? Is that happening in my portfolio? Was another one that I had.
For me, if it was my money, yeah. I mean, I would be thinking about a much more, so get that core sorted out so that you've got more exposure than just the US and Australia. But get the numbers right for you. That might be 50-50, that might be 80-20, it might be 90-10, whatever the numbers are for you. And once you've got that core sorted out, I would be looking to the satellite positions and looking to managers there. I think it would simplify what you're trying to do kind of on a self-directed basis and give you a little bit more process, a little bit more structure, and probably a little bit less work to do. And then perhaps maybe if there is a couple of stocks that you do like, or an ETF that you are particularly passionate about, down the bottom there, that 5% allocation or something like that's appropriate. But I would try and find a process that is simpler, but still gives you more more exposure across the world, but perhaps with less diversification.
Yep. No,
And
understandable.
what about the final piece in the small? I mean, almost 10% of the portfolio is in micro investing apps.
Mm-hmm.
I guess similar commentary there then.
Look, I think the micro investing apps provide people with an opportunity to hack their mentality, for lack of a better word, and round up, purchases and stuff, which feels like an easy way to save money, get it invested ASAP. And I think there's a lot of benefits to it. I've got no real qualms with it. And the portfolios they offer, from what I've seen, are pretty fine. So assuming you're investing along that basis, then fantastic. Outside of that, I would just say to incrementally move money across to your main portfolio that's got a little bit more of a larger investable universe, if that's what you're trying to do, and just make use of that investable universe, rather than the limitations that generally come with some of these roundup apps. You guys kind of know my crypto thoughts. Like, it's not my wheelhouse, right? Like, look, if you're on it and you're doing well and you're happy, take some profits along the way and be sensible about it, because to me it just seems like a leverage play on risk on.
Love it. Well, Anubhav, I hope you've been able to get some actionable insights there. And thank you for submitting the portfolio. I think a lot of people would have taken something out of that for their own portfolio today as well. So thank you very much.
Thank you. I just want to thank you guys to getting me started investing. I started 3 years ago, I think, and I just started off listening to you guys chat, you guys making it seem easy. So I just want to thank you guys for doing that, and thanks, Luke, for having a review of my portfolio.
Mate, you're an absolute legend. These guys have done a fantastic job, and I'm stoked that you put it in for us. So thank you very much.
Yeah, thanks, Anubhav. Appreciate it.
Yeah.
Love that.
Appreciate
All right,
it.
cheers, guys.
Easy.
Good luck with it all.
Thank you. Bye-bye.
Yeah.
What a legend.
All right, bye.
One of the
Bye-bye.
greats, Anubhav. One of my favourites so far. What a nice man.
Thank you to Anubhav for submitting the portfolio. And if you would like to submit yours for Luke to have a look at, head to equitymates.com/contact. Everything is there. Otherwise, you can book in a time with Luke at equitymates.com/advice.
Just make sure you're as nice as Anubhav. That's
Yeah.
only criteria.
And say nice things about us as well.
Yeah, while you're there, exactly right. Give that ego a stroke.
But Luke, as always, thank you so much. We'll pick it up in the next segment.
My pleasure, gentlemen.
So we're going to take a very quick break, and on the other side, we're back with Not Financial Advice, the TikTok Investors Edition. Welcome back to Equity Mates Investing. It's time for a new segment.
This is not financial advice.
That's right. We are back. More for the sting than anything else.
True.
But we come across a lot of terrible financial advice when we're on online, on social media.
Yeah.
Every Friday, we like to celebrate some of the worst financial advice we've seen across short form video, TikTok, Instagram Reels, YouTube Shorts. And I wanted to bring some of those today to the podcast and share some of them with you, Bryce, because it's a jungle out there. And if you were trying to learn to invest just on social media,
Oh my God.
oh my God.
Well, we were speaking with someone the other day who was talking about their son's influence from TikTok, and his current perception of money is that you don't need it.
Yeah, I think the quote was, "You can just dig a hole."
You can dig to
Like to
live.
live,
You can
yeah.
dig a hole in the ground.
It's like,
And we said, "How has this come about?" And he said, "He's watching too much TikTok." So it's a dangerous world out
reflecting on that conversation, I want to meet the creator who's convincing people of that. Like,
Yes.
how good must their videos be?
there.
If this isn't a desperate call to the Australian government to make professional financial advice more accessible. I don't know what is, but Bryce, I've got 3 short form videos to you today.
All right.
Let me introduce you to the world of TikTok investors.
And we don't know how this is going to go because I'm not the best with this sort of stuff.
Content.
Online. I'm not an online guy.
No, that's not true at all.
Yes, it is. I don't go on TikTok.
Yeah, golf content.
Different.
Formula One.
Not on TikTok. No, not on TikTok.
Deep house
Sounds
music,
like we should do
disco.
a sports podcast.
All right, here we
Disco.
go.
All right, boys, here's how you're going to make your first $10,000 in the market. Last year, I took $5,000 and turned that into $100,000 in just 9 months by doing this one simple trick. And that one simple trick is realizing that everybody has lied to you up to this point, and you should never be investing in the big cap stocks like Amazon, Apple, Google, Tesla, etc. Because those stocks, they've surpassed their growth phase, and you're only going to get 5 to 10% gains year over year.
When's he going to tell us the trick?
What?
What's the trick?
Oh, you'll get to it. Everyone's lied to you, but
Okay.
Are you into it?
I am. This is good content.
Yeah, the backing music.
Cliffhanger.
Yeah. All right, you ready?
Yeah.
If you have $1 million in that stock, that's great because a 5% gain would give you $50,000. But if you're anything like the average man out here, you only got a couple $1,000s to invest, which means your 5% gain is only going to get you around $100 to $500 per year, which is nowhere near what you need in order to become financially free. The key to that.
Wrong. 5 to 10% a year. We've spoken about on the show. More than enough.
We've wrote a whole book.
We've written a whole book about it. Wrong financial advice. Not financial advice. 10% a year. This guy's biggest problem sounds like time horizon.
I think so. I think he wants to get rich pretty quickly. All right.
Okay. Yeah.
It's taking your low amount of capital and putting that into a risky asset like penny stocks, like cryptocurrency, like NFTs, and being ahead of the trend, being ahead of institutional investors. If you want to know exactly how I do that,
wrong. You can't. Hard truth. As retail investors, you can't get ahead of institutions.
It's simple. Take your low amounts of capital and get ahead of the best investors in the game.
Exactly. Low amount of capital. Wrong. Anyway, keep going.
That's it. So that's...
Wait, so all he said was just put it in crypto.
Don't invest in large cap stocks.
Yeah.
Invest in penny stocks and crypto ahead of institutional investors.
And he rightly pointed out the magnificent returns that the large cap stocks actually gave people. Oh, goodness me. All right. So there was a lot wrong with that.
All right.
Next.
You need to take a deep breath? Or are you ready to keep
I'm
going?
ready.
All right. Feel free to stop me at any time with you shouting wrong.
People out here flexing that they make 10K a day. And I understand
Wrong.
To the 99.9% that's a fuck ton of money. I get it, and so be it, guys. It's a lot of money. You can live off that. Now that we have that out of the way, let's talk to the 0.001% that understand what 10K actually is. Still hustler money. Let me explain.
But what is? I can't. What is it? What's he saying?
He's saying people who make 10 grand a day aren't making a lot of money.
Wrong.
Wrong.
Who's making 10K a day? How much is this guy making?
Apparently more.
Oh my god. Okay. What's the secret?
No. First of all, he's going to tell you why 10 grand a day isn't
enough.
Yeah.
Is he in a Lamborghini or something?
Nah, he's just... Unsurprisingly, a lot of these TikTok investors sit in front of podcast mics.
Uh-oh. Okay.
I understand. It's a lot of money, perspective. But I'm going to talk to the guys that have big ambitions and big dreams. 10K a day. What is that? 300K a month. What is that? 3 million a year. 10 years, that's 30 million. 40% taxes. What are you left with?
What the hell?
Okay,
This
let's say
guy's
you're left
lost the
with 20.
plot.
Living expenses, you're left with 15. You just worked 10 years and you have 15 million in the bank.
That
I know
is
sounds
more
like
than
a lot.
that is more than many people earn in a lifetime. Way more. This guy's lost the plot.
If you work for 10
10
years,
years,
after all your living expenses, you're left with 15 mil,
million.
you've failed.
Oh my goodness! You can understand why people get so depressed watching this stuff. Yeah. Anyway, keep going.
For context, this guy would be like mid-20s as well. So
Well, how much is he earning a day?
He's not exactly. Well, he doesn't have 15 mil in the bank after 10 years.
No. Okay, keep going.
But it ain't a lot of money because you can spend it really fast. Or I could just work for 10 years and go for 100 million. But I'm going to cash out at the end of 10.
How?
Instead-
What? How? What?
Yeah.
Hang on.
Wait, this guy's only working for
He's
10
only
years
gonna work
and go
10
for
years and
100
get
mil?
100
I'm
mil?
going for a bill.
What the hell? This guy's maths is boy math anyway.
Cashing in at the end of every single day, I'm gonna work my long period of time, and I'm gonna cash out the big bag.
Great, good for you. I have no idea what he was trying to say there.
He was saying
What's
10
he
grand
saying?
a day
10 grand a
isn't
day
a lot
is
of money.
Yeah, but then he's going to work and earn 100 million?
Yeah.
Doing what?
You got to subscribe. You've actually got to subscribe to his official Capital Club waiting room. Link in bio.
Oh
that
my
that
God,
comes up on the
this is
screen.
the world's biggest Ponzi scheme.
You know what? If this segment takes off, we should actually sign up to some of these Discord servers.
Sure, and see what they offer. That would be depressing, because it'll only can further, I guess, highlight how many people get sucked into this stuff. Sucked in for the quick win. I think the biggest takeaway, if you are getting sucked into these videos, is there's no quick win. You can't get rich overnight with this stuff.
Yeah.
Like, come on. All
Now,
right.
final video.
Okay.
Now, I want to give you the context.
We should make parody videos like this.
The thing is, these go so far that, like...
I know, I know.
So, I want to explain what you're looking at here. Two guys in, like, their early 20s, like 22, 23, sitting in front of podcast mics.
Okay.
He said once you have $20 million, like, you can have everything. Unless you want to buy a jet or a yacht, like, you're set. But for me, I'm like, I'd burn through $20 million and, like...
Dude, I could spend 20 million before you could say 20 million. Like,
And I even think, like, 100 million
I mean, I love the ambition.
I know, like, would you
guess,
buy
but,
an
like,
$80 million
burn through
jet?
20
Let's say, you
million,
know,
okay.
you get to the point where
Would I?
you can buy a
Yeah.
jet. Are you ever going to stop? Like, at what amount of money are you going to be like, okay, I'm going to chill out. I'm going to, like, retire, like, chill with my kids.
Never.
No, you don't. You always lease them. No amount of money.
Never.
There's no amount of money. I could spend 20 million faster than you can say 20 million.
And then he said 100 million,
It's
still not a lot of
enough.
money.
These guys' perspective on things.
And, like, this is, like, millions of views on TikTok. Like, this is... Like, we're not scrubbing the deep, dark recesses of this world. This is just, like, what's coming up on our feed.
It's unbelievable. And the problem with that is that it really clouds the view of how you can... Like, if 100 million is not enough amount of money, you're not going to be doing an investing strategy that we've written a book about.
No,
do you know what I mean? Like,
you're not going to do long-term
dollar
sensible
cost
investing.
happy with the market return.
yeah,
You're going to be... I don't know. What are these guys doing?
Well, the amount of stuff that I found about, like, punting on, like, crypto and, like, trying to find the next, like, undiscovered crypto, all that stuff. It's like just get rich quick stuff. And,
Yeah.
I mean, it's not new.
No.
Like, generation after generation
obviously
has
is what
tried to
works.
get rich quick.
Yeah.
It's just with social media, it's supercharged.
Yeah. Well, I think the call out is if you come across a video on your TikTok or
Yeah,
Instagram,
send
send
them
it through, and we'll include it in our not financial advice segment.
And do
throughout
not
the
take
year.
do not take financial advice from social media.
That's it. Well, we're going to leave it there. I do have one big favor. If you are enjoying the show, if you're getting a lot of value out of it, we'd love if you could rate and review us on your podcast app. It really goes a long way in terms of getting us in front of new Equity Mates listeners, and we'd love to hear your feedback as well. If you'd like to submit to Pimp My Portfolio or have a question or are interested in joining us on any of the other segments, equitymates.com/contact is the place to go. But Ren, we'll leave it there. Pick it up next episode.
Sounds good.